G'day, ladies and gentlemen, Australian expats. Welcome to another season and another episode of Expat Chat, episode 109. And as always, I'm joined with my co-host, Managing Director of the EMEA region, Europe, Middle East and Africa region, Brett Evans, who is currently in the desert, which he said is quite cold at the moment, which I'm a bit surprised. How you going, Brett?
Right. Yeah, it is a bit chilly. And g'day everyone, and welcome to 2024. And I think this is season six in terms of how many seasons it's been going for. So got a
Yeah,
few episodes under the belt and a lot of topics to cover, and no doubt many more to come in 2024. You've got a non-election year budget coming up in May, so that's always
mhm.
a frisky time of year. And
Yeah,
mate, non-residency changes, geopolitical events, there's never a shortage of things to talk about. But
no.
obviously today we thought we'd, in our Facebook group, I think there's close
Mm,
to 3,000 members now, 2,800 members. We put
yeah,
up every month, give us your problems you're trying to solve, your questions for the episode. And we thought in this
that's right.
episode, let's just dedicate the whole episode to answering those questions, giving a bit of context, feedback, and just helping good folks make good decisions.
That's right. And I mean, a quick shout out to the Facebook group, the members in there. It's terrific and lovely to see just expats helping each other out, giving them feedback on their own experiences. You got someone that's in Dubai or Saudi giving their experience to someone that's in the UK or the US. It's outstanding. It's great. It's exactly what we want from that group as well.
And if you've been living under a rock and you're on Facebook, type in Australian Expat Financial Forum, join up, and we look forward to seeing you online.
Absolutely, mate. And today, let's jump into that Q&A. But before we do so, I guess, quick disclaimer, throw it over to you, Brett.
Mate, all the information we're going to have the pleasure of sharing with you good folks today should be treated as informational and educational purposes only. Do not construe this as personal financial advice. If you do need to get personal financial advice, reach out to a specialist like Atlas.
Absolutely, mate. Now, let's jump in. A terrific question here, and probably a common one that a lot of Australians face when they do move overseas and they don't give it too much thought, from David. He's living in Seattle, USA, having some issues with accessing the ATO account online. So that's via MyGov. There's been a couple of expats that have jumped to his aid about, I guess, saying that they've been able to get onto it. And it's by way of using that digital ID app in Australia. You can download it on your phone, but essentially using digital AU ID to be able to get into the MyGov app. Brett, what's your experience like with using that now that you're in Dubai and you're not coming back?
Mate, to me, the digital ID works for those folks who were in Australia when digital ID was started.
Came
But
out.
for an expat who's been overseas for longer than the chronology of that time frame,
Yep.
that won't work either. And
Mm,
the easiest way to do it, and essentially the biggest problem with folks are experiencing is the one-time password and the authorization. So
that's
the
right.
best way to do it is actually to can your MyGov application, your login, start a fresh one. And when you set it up, you got to deselect the one-time password option. By doing that, means you'll be able to link up your ATO again and any other services through the government and do it that
Mhm.
way. But it'll mean that, yeah, you'll be able to log in as opposed to not. One thing we always say to folks who are about to move overseas, if you're about to move overseas, go into the MyGov app and deselect the the one-time password option. You
Mm.
will need to get a one-time password to deselect the one-time password. So that's why you need to do it while you're still having your Australian number, because once you get overseas and you can that number, then you'll be locked out of that particular login or that account for good, and you'll have to create a new MyGov account to kick it
Mm.
off again.
Yeah, which can be frustrating because then you got to link all the services again. I think probably the two most common are the ATO and Medicare. And I mean, usually you're having to use, a previous notice of assessment to link the ATO system. And Medicare, it's usually asking you just a couple of sort of, really specific questions for yourself, super number or old statement number or something like that, a reference number to be able to link it. But some good feedback and some good advice there. Jumping into the next question, actually next two questions, because there's actually the same theme here, and it's around Social Security versus the Australian age pension. So first one from Steve. Thanks, Brett, for the ad. Heading home for my daughter's wedding on Monday. I'll be there, Newcastle, for 5 weeks. I'm trying to find out if I can receive an Australian pension while living in the USA. I'm 62 and I'm about to get Social Security here in the USA, but not sure if I can get both. I'm going to squash these questions together. Following on from that, Sam asked the question, Social Security versus Australian age pension. Can you collect both while living in the US? How is it treated from a taxation perspective? How does the mean testing work for the Aussie pension? So some great questions. I might take this question or these questions.
That's your region. Go for it.
Yeah, so I mean, the age pension in Australia is very, very different to Social Security. In Australia, the age pension is means tested. And what that means is that Centrelink looks at your assets, and if your assets are over a certain level based of your age of 67, then you're unable to obtain Social Security, or I guess Australian age pension, I should say. Certain assets are exempt from that kind of means testing, definitely the main residence, but then they take into account your savings, your personal use assets. They look at your superannuation, shares, investment properties, all those things. And if those assets are over a certain level, which isn't much, then you are unable to receive the age pension. And this includes overseas and foreign assets as well. You know, they're not hidden from these kind of tests when it comes to mean testing. You compare that to the US Social Security, which is not means tested. It's actually based on the minimum of 10 years worth of taxes paid into that system. And the amount that you receive on a monthly basis is based on the highest period, essentially, or highest amount of tax that you put into it. And then it's averaged out until you essentially pass away in the US, if that's the case, or when you pass away. But it's based on what you actually kick into the system. It's not means tested. It's not based on, I guess, any assets or anything like that. So very different. In Australia, the age pension is based on your assets. If your assets are under a certain level, based on the means testing, then you'll get something. If they're over, you won't get anything, versus Social Security in the US, which is based on the tax you paid into the system, and then you're getting it back out. When you look at the retirement ages in the US, 62 is technically the early, I suppose, retirement age and able to access Social Security. 67 is probably the most common, 66, 67, depending on your date of birth. And then, you know, pushing out, you know, up to 70, that's when obviously you can still access it. But I would, you know, to some of my clients, I'm not going to give a recommendation on the podcast today, but one careful thing to be in mind is that if you're looking at accessing Social Security, say 65, and based on your retirement assets, you can push it back 1 or 2 more years. Just remember that those monthly payments that you receive, they get indexed in the United States. And the indexation factor is quite healthy. It's about 6.8%. So that's a really important one that if you can just hold off, definitely getting a bit more juice out of the squeeze. And usually it's more than inflation, which is great. So Social Security, Australian age pension, very different. Tax treatment, which was a great question by Sam. So if I'm living in Australia and I'm receiving the US Social Security, I do not need to declare it in my Australian tax return. It is not taxable here in Australia. It is, however, taxable still in the US, but that is the one good thing which came out from our double taxation agreement between Australia and the US. US Social Security is not taxable here in Australia, and vice versa. If I'm living in the US and somehow I'm able to access the age pension, the age pension is not taxable in the US. And that's the reason why we have those bilateral agreements in place on top of the double taxation agreement. But bear in mind, most expats that are in the US for a minimum of 10 years have kicked into the system a minimum of 40 quarters through their Social Security and their tax each calendar year, should be entitled to some sort of Social Security when they reach that minimum preservation age in the US, which is technically 62, but full retirement benefits will be given at age 67 if you delay it until then. That's probably the best way that I can wrap up that question for today, or questions. We'll jump into the next question, which is a really good question. A question here from Mark. I live in the US and I've been a non-resident for 20 years. I've unimproved land in Queensland that I've had for 30 years. Wow. And if I sell it now, how is it taxed in Australia? So, I mean, it's unimproved land. He's owned it for 30 years. He's been a non-tax resident for 20 years. If I sell it now, how would it be taxed in Australia? Brett?
Right, essentially, it's treated no differently to a place with a pile of bricks on it. It's an investment
That's it.
property. So pre-2012, 8th of May 2012, you'll get a 50% discount on the CGT or the gain for that period. So obviously you need to get a backdated valuation back to the 8th of May 2012 as to what that land was worth. Acquisition price minus the 8th of May 2012 valuation, cut that gain in half. You'll pay non-resident marginal tax rates on that. And then from the 8th of May 2012 through to obviously disposal date, there'll be the full freight being leveraged on that as well too.
Exactly right. The only way that the gain might be brought down a tiny bit is if the accountant that you're using is able to assist you with any cost-based adjustments. Cost-based adjustments are usually holding costs. We commonly see them would be council rates as an example. Land tax, if that is being applied to that vacant land, but that would be a pretty sizable piece of vacant land if so. And generally just those types of holding costs. I don't think you'd have probably too many, to be honest, depending on how you've purchased and owned the property, except for maybe a mortgage. So that's just a cost-based element. I believe it's 3. And that's something that might be able to, I guess, bring down the capital gain a little bit. But I would say you're going to be paying a fair bit there in tax, unfortunately, Mark. Jack, can we talk about SMSFs for expats? Good question, Jack. It's a really good topic. Brett, kick it over to you.
I think there's two, I guess, levels of interest here from existing Australian residents about to move overseas who have an SMSF, and also to those who are overseas looking to create one. So if you drill with the first one first, you're an Australian tax resident, you're about to move overseas, you've moved your Australian super into a self-managed super fund. Before we get too much further and lose folks here, if you have an SMSF. So people on the call, if they're going, I wonder if I do have one, you will know if you do. If not, you'll have a standard industry or retail super fund. So, because it's actually something you go out and create, like an entity.
Yeah.
So when it comes to moving overseas, superannuation at a high level under the SIS Act, is agnostic to residency. However, there's a special carve-out for self-managed super funds. And the previous friend, Scotty from marketing, was looking to remedy some of these situations, but obviously we now know he's not only lost the Prime Ministership, but he's actually leaving the government, I saw the other day. So Scotty's going back to marketing. And what it means for those folks out there is in order for your self-managed super fund to be compliant, you have to have both pass a number of tests. And the two main tests that experts have to contend with is what's called the active members test, which means you cannot contribute to that fund. And then the second one is what we call the central management control test. And that has to be in Australia. So the central management control is the overarching ability to hire and fire, not giving your accountant a power of attorney saying, off you go, do it for me, because he can't fire himself. This is that higher level again. This is that like godlike, sort of control on the fund. Now, if you are found out to be overseas and having central management control, sort of like a puppet master telling someone back in Australia what to do, then in the first year, you'll lose up to 40% of the balance. Not of the income, of the balance. So that's a huge, huge haircut. And then if you don't rectify that, by year 2, you lose up to 90% of the balance. So it escalates from there. So you don't want to be caught. Now, a lot of folks out there will do what's called rubber stamping. So they might have a individual trusteeship. They'll take themselves off that and put a brother or a sister or an uncle and auntie or mum and dad on there as a trustee, or they might have a corporate trusteeship. In that case, they'll be the directors and they'll resign as the directors and put someone else in place. Now, the biggest problem with that, and a lot of folks see that, and we see this a lot of the time, is unless that person has an economic interest in the self-managed super fund, then really it's not compliant. It's just you're doing that to try and get around the situation as opposed to addressing the problem itself. If you have a out-of-weight scenario, you might think, okay, what I'm going to do, I'm a single guy or girl, I'm going to go overseas, I'm going to combine my self-managed super fund with my brother or sister back in Australia, join the two together. If you've got 80% of the balance and they've got 20% of the balance and they've got all the control, once again, red flags will appear. The last thing you want to do is have to justify yourself to the ATO. And this is the ATO government, this, by the way, folks. So we're not talking about some other government body that's a toothless tiger. The biggest problem we find is the ATO is on the warpath, not just for expats, but SMSFs in general, in that they've been sold to them inappropriately. So what that means is people who maybe shouldn't have had a self-managed super fund have one. And the ATO is actually calling trustees up and saying, doing a test with them, saying, hey, do you know what you've got? Do you know your responsibilities and so forth? So it's not something you just jump out and do. Self-managed super funds are very good at holding physical assets.
Yes.
Property, vintage cars, artwork, gold bullion, physical things. Unless you're not holding those type of assets, if you're just holding shares and ETFs, go into a retail master wrap. Do not do a self-managed super fund, because it just exposes you to so much subjective conjecture in terms of are you compliant or not. If there's, I guarantee, if it's a grey space and it's on the fence, the ATO is going to rule against you, and you're going to lose almost half your balance. So if you can avoid it, if you're just looking to use an SMSF because you want more control, reach out to us. There's a lot of other compliant options, and a lot of our clients do it. You don't need to go down the route of an SMSF. And anyone who tells you otherwise clearly does operate this space on a daily basis.
No. And I mean, and you briefly touched on it, but even just the cost of running an SMSF for, remember, you're having to do a tax return, much like you have to do an individual tax return, audits. That alone can range from $2,500 to, $5,500, depending on what you're actually doing. But then on top of that, you've got the investment costs as well. So they're just, they're not the ideal solution for expats. I know back in when the budget was released, they did mention how they were going to create some flexibility there, but they've shut that down pretty quickly. That actually hasn't copped too much more news, to be honest, after they announced it. So I think they've shelved that.
You've got that 2-year temporary absence rule. So what that rule says, if you move out of the country, you have 2 years to remedy the situation. If you breach that 2-year period, you're done. They were talking about changing that to 5 years. And they're also talking about removing the active members test. That's right. All gone the way of the dodo. We know Labor doesn't like SMSFs because it goes against their policies. So I don't think that'll ever see the light of day again in terms of those changes. And unless the Libs get back in, I think it's done.
Yeah, I agree. It'd be interesting to see what happens over the coming weeks and months, because they're playing with those stage 3 tax cuts as we speak right now. So see what else comes out of that from a tax aspect, maybe residency changes as we lead into the budget again. Another question, that was a really good one then, from Rani. Super contributions as a non-tax resident, is that still taxed at 15%? I mean, another really good question. And I think we could both break this one down, Brett. I might start with non-concessional contributions and just give a bit of a high-level understanding. So whenever you're looking to make a contribution to super, there's technically, we'll say 2, but there's more than 2 types. I'm not going to get into downsize or contributions and all those things today. Let's just break it down into the 2 classifications. There's what's called concessional and non-concessional contributions. I'm going to talk about non-concessional. I'll give it to Brett to talk about concessional. Non-concessional contributions are treated as after-tax contributions. So when they go into the super fund, they are not taxed at 15%. They increase your tax-free component within your superannuation fund. You have an annual cap of $110,000 per financial year, or you can trigger what's called the bring forward rule, which allows you to put in $330,000, which is triggering 3 years worth. And then you need to wait until those 3 financial years are up, even though you did it only in one lump sum amount. And then you can start recontributing non-concessional contributions. They can be a really great way for returning expats or expats in general to add a very large amount to their super quickly, because they haven't given their super much attention whilst they've been away. And often super still becomes probably one of the main pillars, if not the main pillar, as part of an expat's retirement strategy, because often they do return back to Australia to retire. So it does pay to give it some attention. I'm going to pause there, and I'm going to hand it over to Brett to talk about concessional contributions.
Yeah, look, so like what James said, with a non-concessional contribution, it's after tax, so it's out of your own pocket. So you get paid a salary, the money goes in your bank account, you transfer that across into super, and that's why it's not taxed. Concessional is what we call pre-tax contributions, and sort of give an example that helps people frame in their minds how it works. When you lived in Australia, your employer made their what's called their SG, their superannuation guarantee payments into super. So let's run an example of, I know it's changed, but just to keep numbers round, let's say
Yep.
the SG rate was 10%. So 10% of your
Yep.
salary goes into super. So let's say you earned a gross salary, including super, of 100,000 Australian dollars. So what would happen is your employer would move $10,000 of the 100 into your super account. And that gets taxed at 15%. That's contributions tax. They may be asking, well, why are they taxing that? And the reason being is your assessable salary, so what they calculate your marginal tax rate on, isn't the 100,000 anymore. It's 90,000. So whatever amount gets contributed to super by way of a concessional contribution, a pre-tax contribution, discounts your assessable income. So now suddenly, instead of paying marginal tax on 100,000, you're actually paying marginal tax on 90,000. The only time that a expat, well, there's probably three occasions that come to mind, should contribute to super as a concessional contribution, as opposed to what James has talked about as non-concessional. Number one, you're running positive cash flow on a property in Australia, on a rental property in Australia. If you're running positive cash flow, let's say, for example, $20,000 a year, you'll pay 32.5% tax because there's no tax-free threshold and at the non-resident marginal tax rate. So instead of paying 6,400, whatever it is, in tax, you take that 20,000 and move it across into super as a concessional contribution before the 30th of June. Instead of paying 32.5% tax, you're only paying 15% tax because you've reduced your assessable income down to zero by moving it across. Now, there is a limit of $27,500 every year that you can do. So you can't breach that limit except in one scenario. And that's the option number two. You can go back and do what's called a catch-up concessional allowance. So for those folks who've been overseas for a while, they've probably never contributed to super by way of a concessional contribution. So they're probably thinking, why do I want to do that? Let's say, for example, you sold an investment property in Australia. And obviously there's a bit of capital gains tax there. Canberra thanks you. The ATA thanks you for your kind donation. But before you give them too much, what you can do, you can go back up to 5 years and bundle together all of your allowances that are unused. So if you go back and look at the current limits, because they changed from 25 to 27.5, so there's a bit of a step, but it's about $150,000 you can take out of the proceeds of the sale of that property and put them into your super account and claim that tax deduction. So now let's look at that 150,000 example. You would have paid 32.5% tax up until 120, and then 37% tax from 120 up to 150. By putting it across into super, now suddenly you're only paying 15% tax on the whole lot. Yes, it's stuck into super. Super is like the mafia, once in, never out. But as long as it maps to your financial plan and funding your retirement, you've just cut your tax rate over half and funded your super. So it is a good scenario. The third case when you do a concessional contribution is when you're in your later years, you've maxed out your non-concessionals, you've maxed everything out, everything's to the bill, and you'd really just want to pump money in there. And the 15% tax is a price you're willing to pay to be able to maximize your annual contributions into super. So in a nutshell, that's concessional contributions.
Yeah, I think we covered it, ladies and gentlemen. You should all know as much as us right now about contributing to your super fund. Moving on to another question here from Sean, or Sean, we'll say Sean. Hi team, currently in the UK and considering a move to the Middle East, we have a property in the UK which the accountant says we can rent and still claim the tax-free personal allowance as a non-resident. Now that's referring to the UK tax side, not the Australian side. If I was to buy a property in Australia, could I claim the tax-free threshold? Thanks in advance and have a Merry Christmas. Okay. I'll take this one. So, and it's something that actually Brett pretty much talked about briefly then, talking about contributing to super. When you are a non-resident for tax purposes of Australia, you do not have a tax-free threshold. You pay tax on the first net dollar at 32.5%, and that first tax tier is up to 120,000, and then it goes up to 37%, and then up to 45%. So no, in Australia, if you are a non-resident of Australia and you have rental income that's positively geared, then you'll be paying 32.5% on that. We don't have a tax-free threshold. When you return back to Australia and you return being a normal Australian tax resident, you will have a tax-free threshold. And right now, that's what they're talking about in the background in terms of stage 3 tax cuts back in Australia. They're looking at making some amendments there, some tweaks, tax-free thresholds, including that one. But for those listening today, if you are a non-resident of Australia, you do not have a tax-free threshold. You pay tax on the first net dollar. I'll leave it at that and we'll move on. Good question, long question here from an anonymous, and I'm going to read it out. I'll try and paraphrase it a little bit as it's regarding CGT, foreign resident, capital gains withholding, and property and tax. So reaching out for some general direction here, I'm having trouble interpreting the capital gains withholding with a contract price less than 750,000. Context: I'm an Australian currently living in Canada and I'm a resident of Canada for tax purposes. I hold Australian property of my former main residence and an investment property. Just trying to paraphrase that one. If I sell the investment property for market value of around 650,000 while I live in Canada, will I have to do a foreign resident capital gains withholding? Question. And what are the other tax implications I might run into or should be aware of? Question. So 2 questions there. I mean, it's a 2-parter. Brett, did you want to talk about the foreign resident capital gains withholding tax?
Yep. Yeah, look, that's essentially a tax that the government brought in, not so much the target expats, but foreign investors who were buying a lot of Australian property. They sell the whole thing for a big gain, and then rather than paying tax, they just repatriate all the money back overseas. So that's originally right. It was 1.2 mil, I think, from memory, and essentially any property value greater that or transaction greater that, the government required the purchaser to hold on to a certain percentage of the proceeds, and then you sort that out in the wash when you do your tax return, whether you owe more tax or less tax, and they give you a refund or you need to pay some more. That's now been brought down to 750. So what that means for this lady or gentleman, I can't remember who it was, essentially, if Anon, there you go. So it means that when it comes to the sale prices below the foreign resident capital gains withholding, there is no requirement for any withholding. So you can sell it. Now, obviously, on the other side, you've got the capital gains issue, mate, and I'll hand that over to you, and you can you can run through that one.
That's right. So the second part was any other tax implications they should be aware of, and there are. It's an investment property. We don't know how much the property costs, so we don't know the capital gain in this instance. But if he is making a capital gain on an investment property, then it's important to be mindful that he will have to pay capital gains tax. The rate of tax will be at the non-resident rates, 32.5%, 37%, and then 45%. He will be able to, or she will be able to use the 50% CGT discount concession, up until the date that they left. In this instance, it would be very smart to get a market valuation as of that time in which they left Australia. That's a really good way to segregate that period of capital gain. It helps provide that demarcation line in the sand. And then any period of capital gain that has accrued whilst being a non-resident, unable to actually claim the discount concession for that period. So there is a bit of workings in that tax calculation, but all in all, there definitely will be some other tax implications, which is the CGT, and then paying it at the non-resident tax rates. So that's a goodie, but I think we've covered that one quite well. Moving on to a question from Peter. And this one is about super. So given the tax agreement with the USA, so referring to the double taxation agreement there, DTA, if you have rental income in Australia and make a pre-tax super concessional contribution, the timing of this question, which reduces your taxable income, does the IRS respect that, or do you end up still having to pay them the difference? Oh, it's a really good question. And I guess right now, going back and looking at super and the IRS, it's always a bit of a grey area. But I do know that there is a tax agreement there where, because you're technically still paying tax within the superannuation environment, which is that 15% tax that Brett just talked about previously, you still are able to use that as a tax credit in the US within your individual US tax return. I've seen US accountants use it. So you're still getting the concession there, absolutely, and you're still getting the tax credit benefit there. And another, I suppose, addendum to that is you are building up what we call US basis within your super fund. Because you've already paid tax on that component of contribution into the super, you're building up US basis where you shouldn't have to pay further tax on that very small amount from the rental income. That's US basis. That's what that refers to. So technically, the concession and the benefit is still there. You are still going to get a foreign tax credit on the US side. And it's a good little way to save tax on the Australian side. Absolutely. So good question. Last question for today from Mark. Property question. Property's in the air today. Hi, everyone. I hope you're all well. Looking for some clarification and help around the CGT exemption rules. I'm trying to get an accurate understanding of the rules and myths. So this is going to be in regards to the main residence exemption. I've owned a property in Melbourne since 2010. I moved overseas in 2019 and rented it out since I left, so 4.5 years. I'm not intending to return to Australia for another 5 years, at which point I'll return and live in my house. Let's pause there. He said he's rented out since he left up until, say, now, 4.5 years. He's not coming home for another 5 years, so he would have rented out in total 9.5 years, technically, by the time he gets home. When he returns, he'll move back into it, and then he'll move back into it and then sell it roughly a year or two later. I'm wondering if I should stop renting prior to the 6-year CGT exemption window, if it actually makes any difference, given I will still be a non-resident for tax purposes. That's probably a good part there to pause for that question. So really good question. So if he continues to rent it out, he would have rented out for 9.5 years, which means he would have gone past the 6-year I suppose, temporary absence rule or that relief rule. Why don't we actually just give a quick overview of what that actually is, Brett?
Essentially, a lot of folks don't realise this. If you are living in a principal place residence in Australia and do move overseas, the general assumption is since the 1st of July 2020, all expats have lost access to the main residence exemption, which is not exactly true. Because what you can do is move back into that property, resume being an Australian tax resident, which is the qualification to access the main residence exemption and re-engage that. So think of it bookending. You lived in it, you moved out, you're moving back into it. By bookending it, you either get access to a full or partial main residence exemption. Access to a full main residence exemption is if you move back in within that 6-year period. A partial is when, let's say, you're overseas for 10 years, 6 of the 10 is not accessible, 4 of the 10 is. However, and this is where I think this question's going, when you stop renting it out before that 6-year period starts, you actually get indefinite main residence exemption. I'll let you run into this one now, mate. That's a good one.
Yeah, exactly right. So you're only using that 6-year exemption period when you're renting it out. So that's the easiest way to look, and that's exactly what Brett just said. If you're coming to the end of the 6 years, you kick the tenants out and then you just leave it as is vacant, it's not for rent, then you're no longer renting out past the 6 years. So you're not accruing any additional time that is, I suppose, making up an amount which would be taxable from a capital gain aspect. Let me reframe that because I didn't frame that correctly very well then. If you kick the tenants out before 6 years and then the property stays vacant, and then you come back to Australia and then you sell that property, assuming you're an Australian tax resident, you haven't purchased another main residence, then that sale would be tax-free because you had never rented out past the 6-year period. That's it, full stop. And I guess that's where he's getting at right now. Should I stop renting it out as I'm coming up to the 6-year period? Or I guess, should I keep renting out? And this is the second part of the question. Should I keep renting out? And how would the tax calculation look then? I suppose another caveat is if you were to sell this asset as a non-resident, remember, you're not entitled to the main residence exemption at all. That's really important. Whereas if you rent it out past 6 years and you are a resident, an Australian tax resident in the future, you will be entitled to the partial main residence exemption, which is exactly what Brett said before. So that's a really important one. But do you really want to miss out on 4 or 5 years worth of rental income just to keep it vacant? And I guess an important, and this is something Brett and I were talking about just before, and Brett really drilled down on it, said, well, you really need to run a cost benefit analysis. There's a few assumptions in that, but Brett, I'll kick it back over to you.
Yeah, so I mean, essentially on one side of the ledger, it's rental income coming in. The fact that he doesn't have to rent it out, or he has the ability to make that choice, to me tells me his mortgage is done. So the rental income's just, rental income, obviously net of any council fees and those sort of things. But you need to put on that on one side, and as in how much that would be over a 5-year period, and on the other side, what part you lose out on when it comes to any obviously tax benefits or those sort of things in the selling process. So if you do a rough model of what you think your property's worth, work out what a rough no one's ever perfect, but worst case scenario CGT liability would look like, and then from that map the two together, bearing in mind you can use the concessional contribution, catch-up allowance and those sort of things as well to reduce that tax liability greater than 6 years. But everyone's different. I mean, I've got clients who don't rent out their property because they don't want the place to be experiencing too much wear and tear. So that's a opportunity cost they're happy to look past. But it really comes back to that two side. Yes, you can do what he's proposing. Yes, you can sort of not rent it out and receive indefinite main residence exemption and move back into it at some point in time. But it comes down to, obviously, as you and I will say, the Excel spreadsheet answer. You're foregoing 5 years worth of rent at whatever rate that looks like versus potentially paying tax at whatever that looks like in terms of an assumed rate of return, and then map the two together. And he knows why he's considering that option. So overlay that with his decision-making matrix and go from there.
That's right. And I mean, there's a flow-on effect there as well. You could take that a step further. It's like, you could be missing out on 5 or 6 years worth of income that you could be using to build other assets. Don't know how old this guy is, but assets, say, towards your retirement. It's just, that's another opportunity cost that you're not, anyway, sacrificing.
We're not talking 1 or 2 years either. It's a 5-year period to serious time frame when it comes to getting a compounded rate of return. And you only need to, an extreme example, but if you got a 10% return every year for 7 years, you double your money.
That's exactly right. Really good question, Mark. Hopefully we've addressed a few things there, because there's definitely a few things in it. But yes, definitely need to run a cost-benefit analysis. That's actually our last question for today. We've actually drilled down on quite a few today, so that's great. I'll hand it back over to you, Brett.
Hey, let's wrap it up. I think we've monopolised our listeners' ears and eyeballs for long enough. Just remember, if you don't know about the the Facebook group Australian Expat Financial Forum, Google it on the Facebook, or even go through Google. It helps up that way as well too. Jump in, you'll find there's just a sea of Aussies dealing with the same issues that you're dealing with in terms of how to make smart decisions, and we're in there obviously providing guidance and feedback where we can. So mate, let's wrap it up there. Thank you once again. Happy New Year, and looking forward to being of service to everyone in 2024. Once again, I'm like a broken record. The only thing we ask for in repayment for this episode and many more is just the rating and review, please, guys. It means the world to us. We do watch it, and we know when people do it because then we see our audience start to build out. So
that's right.
It's through your kind ratings that we're able to expand the show and reach more Australian expats and help them make more smarter decisions.
Absolutely. Thanks, guys. Thanks for tuning in. We'll see you on the next episode. Let's have a good year.
Cheers. Thanks, guys.